Okay, now that we've journalized everything that's happened, typically what's just happened is we had a bunch of receipts or checks, and we were able to analyze what they meant, and this is what we came up with. Now, a typical business may have dozens, hundreds, maybe thousands of these per month, and a manager or an owner isn't going to be able to tell what's going on with the business by looking at all of these. So we need to summarize this somehow. And this is the next step in summarizing these. We're going to take all this information and we're going to transfer it to the accounts. Now, here we're going to do it to the T accounts. If you're using Simply Accounting, they get transferred automatically. And part of the reason we need to transfer them to the accounts is we need to know what kind of balance we're going to have in each of these accounts, how we're doing in every account, and then we're going to need to know whether they balance or not. We need to make sure we didn't make any mistakes here. Humans have to do this, okay? And human error does exist, does happen, and if it doesn't balance, we need to find where we made the error. So we're going to do lots of these as the semester goes. So here I need to take this information and put it in here. So here I got $5,000 in a bank of debit. So here, that's going to come over here. Now, here I've got it done. So the $5,000 is going to go to cash. And here, the $5,000 credit has to go to capital on the right-hand side. The next transaction, we had equipment of $2,000. So we need to debit equipment $2,000, and we used $2,000 from the bank, so we have to credit cash $2,000. So that goes on the right-hand side. Third transaction, we've got $200 worth of supplies. So supplies has to be debited $200, and we incurred some debt here. Okay, so we have a payables of $200. So payables has to go up $200, and because payables is on the right hand side, you increase it by putting it on the credit side. Next transaction, we've got a van, which is an asset, right? So we have a new asset, it goes up. So van is debited $1,500. We paid $500 cash, so cash has to be credited. Okay, so we already had a $2,000 credit, so we put it on the next line here, so for $500 credit. And payables went up, so we have a second payables here, so payables just went up another $1,000 here. Next transaction, okay, we provided service for cash, so cash is going up, so we're going to debit cash $750 here, and service, okay, so capital goes up $750, so this is revenue. Next, we provided service now on account. So accounts receivable will go up, so it's debited $1,000, and revenue goes up $1,000, and for capital to go up $1,000, it has to be credited on the right-hand side. Last, we paid some of our debt, so our payables went down. Now, in order for a payable to go down, it needs to be debited, and cash also went down, and that needs to be credited. So on the right hand side. So here is all of these transactions posted to your accounts. This needs to be done either manually or with Simply Accounting. You hit the transfer or post to accounts button and it will automatically post to these accounts. Now whether or not they're going to balance, that's what we'll learn next.